Okay, we're live. I don't know if anybody's in yet. I don't think so, but yeah, we're on, I think. Okay, hi Neeraj. We are just going to wait for we've had about 370 odd registrations, so I'm just going to wait for 50 to kind of turn up before we go live. A recording of this webinar is going to be available after the presentation. We're going to quickly run through about 20 to 30 minutes um, of content before we move on to to something that will be question and answers. Excuse me. Um, okay, I am now going to share the presentation right here. Okay, I'm not sure if you can see this presentation. Okay, you seem to be getting a lot of people in here. Okay. Okay, hi everyone. This is Deepak. I'm not sure if you can see what's on the screen, but let me just see if there's a problem with this. Slides not up yet? Okay, this is strange. Stop the screen share and let me see what's happening with PowerPoint. Well, here you go. I'm gonna try and load up the screen shares. Okay, this should share at least. Can you guys see the screen? Yes, that was me. Okay, 7:01. I think we are ready to go. Okay, here you go. Yes, I hope you can all see the screen. I hope you can hear me properly. If you can't, just focus on the chat channel. My name is Deepak Shenoy. We have Vashisht also. He's going to be the controlling anchor, and we're going to talk about how you can use Excel so you don't become a sucker. Don't get fooled into financial products. And the reason we're using Excel is because it's ubiquitous. All of us seem to have it somehow or the other, but it also provides us a very easy to use formulas for being able to be identify bullshit from the real thing. But first, before we move there, we would like to uh, look at the very basics. Okay, a lot of people look at where to invest. Do I buy a mutual fund? Do I buy a stock? Do I buy that mutual fund or this mutual fund? Should I buy a balanced fund or a dynamic fund? All this stuff is really the wrong place to focus. It's not really about that. It's more about how much and the when that matters a lot more. Do you choose, for instance, the market now is here, am I going to take my net worth out of all the fixed deposits I have and dump it all in the market at one shot? Am I going to do something else? That stuff, how you size your positions, how you size your portfolio, how you have a disciplined plan, that makes a lot more difference to your future compared to whether you bought a product that did 11.62% versus something that did 11.64%. That stuff is just less meaningful than the little nudges that you create that add more value to the your future and your portfolio than the chance that you'll find a phenomenal investment. And now, having said that, we always get products that people come to us with, and we are going to answer some of these questions in the form of Excel formulas. Okay. Uh, Sorry. About that. Okay, here we go. The first thing that we're going to do is, what does it really mean when somebody comes to you with a product like this? Okay, and this is a real product. You put in 100,000 rupees a year for 10 years, then you stop paying. We will give you back 20 lakh rupees after 15 years. Now, see the complications that's happening. You're putting 100,000 rupees a year. You're going to pay for 10 years. That means you're going to pay 100,000 into 10. Your mind is telling you 10 lakh rupees. Then you stop paying. And after 15 years, that means another 5 more years, and we'll give you double your money back. So you're thinking, hey, I put 10 lakhs in and he's going to double my money in 5 years. This is fantastic. Is it great? Is it really? Let me now switch to Excel and show you how some of these things work. So I'm going to switch here to Excel. Now I'm going to do a quick switch, which is in my Hangouts. And here you go to my Excel. I hope you can see this, everyone. Fantastic. Great. Okay. Um, I'm assuming you can see this. Blurred a little bit, is it? Okay, great. It should be coming out fine in the eventual presentation. There will be a recording of this as well. Now, look, every year I'm going to put 100,000 rupees. This actually means I will just move this formula a little bit so that you can see it. This is 1 lakh rupees per year for 10 years. And let us assume, okay, I don't know what they're talking about in terms of an interest rate that one would achieve. After X years, that means number of 10 years. How much money do I have? If I just put 100,000 a year for 10 years, I'm going to use a formula here. I hope you can see this. Forward value of, I'm assuming this interest rate, okay, of 7.5%. And I am going to put the period as 10 years. N per is period. Payment is the amount of money I'm paying per year. Today, present value, PV, is 0. That means I have nothing today. I'm just going to put this together and enter. This gives me 14 lakh rupees just by itself. Okay, so I want to just say minus of that because of FV is actually called the future value. Okay, so the future value after 10 years, I paid for 10 years. Then this is my principal, the 14.14708 lakh is my principal for the next 5 years. The same thing, remember, I did not pay for 5 years. The idea was pay 100,000 rupees per year for 10 years and don't pay more. We give you back uh, 20 lakh rupees in 15 years. That means 5 years more. So I put 5 years more. This is my principal. What's my eventual result at the same interest rate? Now this can be any interest rate. I'm just saying at 7.5%, which is what you can get in an average FD or a 15-year perhaps bond today. You will get easily 7.58 more percent, in fact. But let's look at 7.5% as the rate. I'm going to just say equals FV again. This is the future value at the same rate of interest, comma, for 5 years. Number of N per, which is the highlighted element here, is 5 years. Payment, I am not going to pay anything. Remember, I've already paid for the first 10 years. I'm going to pay 0. But present value, because after 10 years I had this value, I'm going to just say equal to this, and I press enter. This is actually 20, and I put a negative sign in here because the future value is negative. So 20.3 lakhs. That means this product is equal to just 7.5% interest per year. Sure, they call it tax free and all of that, but you can get 7.5% by investing in pretty much anything that is even fixed income that you can take out after 15 years. And we've actually done a much more detailed video on how you can save about 80% tax compared to a fixed deposit. Just put it in a medium term or long term debt fund, it'll probably return this or more. So you've got this entire product is just a 7.5% investment. Having said that, you can change these values now because now you know this. Let's say I was told to pay 50,000 rupees a year, but I was told to pay only for 5 years, and after that, the value became 10 lakh rupees, right? So right now, I paid 50,000 rupees for 5 years. At 7.5% interest, it became 4.17 lakh. I'll keep increasing the interest because somebody said he'll give me 10 lakh rupees. So I'll make it 15%. At 15%, we get 6.78. At 20%, you get 9.25. So a 50,000 rupee per year for 5 years, then after 5 more years, they will give you back about 10 lakh rupees, is actually about 22% in interest. So that's a fantastic deal. But the same thing over here. If this you get this deal, this is a bad deal because it's giving you just 7.5% at the same values. Uh, in fact, yeah, this is about 8.3. Well, you have to invest for 10 years. Yes. So that's giving you 20 lakh rupees. You can think about it and say, well, I could do this myself. Absolutely, you could do this yourself, and that's the point. Actually, the reason why, if they were able to get, if you were able to get 10% of your own, for instance, you did a blend of equity and debt, you did something like that, which kind of gave you 10% return. By yourself, you could get 25.6 lakhs in the same investment. Change this number, change the interest rate even to 8%, and you're still going to make 1,28,000 more than this product. I hope that part is interesting or clear. Um, this okay, we will have this in this presentation available to you later. We also have the link pasted on the right hand side in case you're missing it. The second thing that people always talk about, and I mean, and let me show you this example before I go forward. This is a mutual fund. This is an HDFC Crest, a highest NAV guarantee fund. The idea was they told you something about 5 years ago. They said, boss, you put money into HDFC Crest. We will give you a guaranteed NAV of 15 rupees after 10 years. Okay. So this was about 5 or 6 years ago. So the 10 years aren't complete. But what has the NAV become? They said they will give you the highest NAV after you invest or 15 rupees, whichever is higher. It has been 5 years since then, from 2010 to now, 2011 to now. The NAV is only 13 rupees 84 paisa. So that is not all that convenient. But the absolute returns is 45%. This sounds interesting, man. 45% in 5 years. This must be absolutely fantastic. Let's see what it really means. Okay, 45% in 5 years. That means your 100 rupees became 150 rupees. You put 1 lakh, it became 1 lakh 50, 1 lakh 45. You put 10 lakhs, it became 10 lakh 45. You bought a house 5 years ago for 50 lakh rupees, it became 74 lakh rupees. That is 45% appreciation. What is it really in interest rate terms? Okay, so I am going to use the rate formula. The rate is equal to the rate into the period, number of periods, which is 5 periods, means 5 years, comma, payment is 0. I am not paying anything. I started off with some number, and what was that number? I started off with 100. It became 145. That was what absolute return of 145%. 45% means 100 became 145, and I'm just going to make it a minus sign because this Excel likes one end to be positive, the other end to be negative. What is this really? 7.7% in 5 years. You've got marginally above, maybe about the same level as a RBL Bank FD. If your 50 lakh rupee house appreciated to 74 lakh in 5 years, you are essentially making very, very little real money. Your house needs to appreciate substantially more. Most people don't understand this. They buy a house, they say 20 years later my property doubled, my property tripled. It means nothing. Let me give you the same example. I'll, in fact, instead of saying 145, I will do minus 100 into 1 plus this amount. So I'll show you what it means if your money doubles in 10 years. So I got 100% appreciation in 10 years. It's just 7.2%. This is the rule of 72, which means take 72 and divide it by the number of years that your amount doubles by. So if your amount doubles, if your investment doubles in 9 years, 72 divided by 9, so let me just show you this, is equal to 72 divided by 9 is 8%. That is what it means if your money doubles in 9 years. If it doubles in 6 years, then you can just say 72 divided by 6, that's 12%, and so on. These are approximates, but the idea is that. But let me give you this bigger example. Let's say your money went up 3x, 4x, okay, 400%. You got absolute return of 300%, which means your 100 became 400 in 20 months. That is still 7.2%. Your 3x increase in 10 in 20 years is still not substantially great. Many of us sometimes get suckered into this by saying, I'll double your money in 5 years or 10 years. I'll give you 10 rupees, it will become 20 rupees, and so on. That's just the way. This is just another way to look at it. Now, coming to this, I'll just pause here if there are any questions. I can't see any questions here. Okay. Okay. Okay, you can go to YouTube and increase your quality. Another piece that I'm going to take you through is the bank loan. The bank tells you that you got 100,000 rupees per of a loan, 1 lakh rupee loan. Okay, and your payback is 11,000 rupees per month. Now let me just see if I can switch you on, but I won't. Okay, I'll just show you how this works before we switch back to the presentation. The payback period is 11,000 rupees per month. So this is great. I mean, I'll just make it a bit bigger so you can see it. The loan is 100,000 rupees. Your payback is 11,000 rupees per month. Period is 10 months. So you're thinking, oh, wait a second, I'm paying 11,000 into 10 months. Okay, that is equal to 1 lakh 10,000 rupees. I borrowed 1 lakh rupees, so I paid 10,000 rupees, which is 10%, right? Wrong. I'll show you how you calculate it. You just use is equal to rate again. You're saying, listen, I have a loan of 100,000 rupees. Its present value is 100,000 rupees. Okay, so in 10 months, I am going to see. That means, okay, let me just move this to this. So in 10 months, comma, I am going to see the present value, the payment of 11,000 rupees per month. Take a present value of minus of my loan amount. That means minus of 100,000. Minus of 100,000, because I mean somebody's given me 100,000, so net technically I'm negative 100,000 and my forward value is 0. I'm just going to say okay, and this is a rate per month because I've done 10 months. That's the period that we talk about. Let me just, okay, let me just move the number of decimals uh, a little bit this way, and then let me also multiply it by 12, because monthly interest rate has to be annualized. The annualized interest rate is 21.3%. This loan, this extremely innocuous looking loan, is like cutting your hand off because it's 21.3% interest that you're paying. Why is it like that? I'll give you an example. Let me show you how they actually do it. Okay, let's start with an assumed rate of 10%. Assume just 10% is your rate. First month, your outstanding amount is 100,000 rupees. Month zero, outstanding is 100,000. Because you aren't paying anything back, at the end of the month, some interest rate will accumulate. And how much is that? I'm going to take this number. This is dollar C dollar line is a way you use Excel to say, show me this, fix this cell, because otherwise, if I say C9 and copy this cell down, it will become C10 for this cell and C11 for this cell. I just say dollar C dollar 9. The idea being, this is my interest rate. 1 plus the interest rate is my, so 10% divided by 12, that's my monthly interest rate into the outstanding amount. So it became 1,833 rupees in the end of month zero, the first time I started paying. Now what do? I take this, I pay my 11,000 rupees, I subtract it. So my outstanding now becomes 89,833. This I tack on more interest, again this outstanding into the interest rate on a per monthly basis, so I divide by 12, and that's my new outstanding. That again in this end, in the second month I will pay back 11,000, and so on. So this becomes, goes on and on and on and on. My outstanding plus interest keeps coming down until the ninth month, where it has fallen to 5,435. But the 10th month I pay 11,000. So I go from an outstanding to, I paid more. Why have I paid more? Because the interest rate I assumed was 10%. It's not 10%. I paid more. That means the interest rate must be more than 10%. That's why I've paid more. So is it 11%? No, the amount is still negative in the 10th month. I need to make the 10th month amount zero. Actually, this amount should be zero, or this amount should be zero. Let us see how we can do that. We can go to data, and there's something called goal seek, right? So you've got um, well, I don't even know where this is in Excel nowadays. There is, I think, formulas and goal seek, or data and goal seek, but I use a shortcut called Alt TG. So it's called goal seek, right? So you can actually, I think it's somewhere over here. I'm not sure where it is. Some one of these data tools. Um, in a goal seek, you can say, I want to set this cell. I want to set it to zero by changing this cell. So I will say by changing this cell. So I'm changing this cell to zero by changing this cell. So let me just say okay. And what it will do is calculate that interest rate for me. It will just keep iterating, and it will calculate that interest rate. It's the same 21.3% which we use using the rate function. So the idea is you can always go back to first principles and calculate outstanding plus interest. You know why you would go back to first principles? Because let us say at the in the middle of this 3 or 4 days, the month 3, I decide, what, I have some money, I'm going to pay about, say, I don't know, 6,000 rupees extra. So if I pay 6,000 rupees extra, how does my balances and amount I need to pay change? Then you can use these first principles to kind of calculate a new way to get to zero, maybe in the ninth month instead of in the sixth, in the 10th month. So that is another way to do this. Let me now go back to the presentation, and kind of take you through whatever's available. Um, Here you go. So we've done, okay. Um, yes, can you see this? I suppose you can. Okay, here you go. So before we continue, I hope if there are any questions, you can let me know. The Excel sheet, yes, we can take down the Excel sheet. What if analysis goes? Okay, I'm sorry, I couldn't see this right now. It's this whole new Excel thing is, I use keyboard shortcuts a lot, so we can give you the Excel sheet later. We'll send you how to do this going forward. Okay, so Vashisht, can you mute your mic? I think I can hear a bit of noise. Okay, here you go. Fantastic. Okay, so we've also got now a small ad right in the middle of this. It's like a TV thing where we're going to do a little ad in the middle. We have um, we have a product called Capital Mind Premium. We will send you. You'll see a link on your right hand side now. Now we wanted just 12.5% for the long term. We've got a long term portfolio that's done very well. It's just about 40% till September 19th. In 2016, we've got about 40% of return. There are a ton of other ways we discuss in the Capital Mind Premium, where we talk about options, bonds, momentum stocks, themes, long-term stocks, but more importantly, we talk about the process that we use to get these returns. So it's not something where we tell you, oh, this is what you want to buy, this is what you want to do. The idea is to tell you different ways that you can do it yourself, so you can find out where to go. And the important thing is about, if you know when to invest and how much to invest in, then it doesn't matter that you're getting the best kind of return. I can show you stuff. We've done things with options that have yielded about 27% in 8 or 9 months. This is a product that uses leverage and derivatives and math and volatility to figure out the best kind of return. But that's not for everyone. Some people, it's plain old mutual funds, liquid mutual funds, that can do the trick. Some others, it'll be a combination of debt, equity. Some others, it'll be the options and the trading. It doesn't matter what it is. The idea is You have to have the approach right. It doesn't matter how much in a return something gives. The point is to secure your financial future, and we offer a 10% or 20% off. In fact, for anybody who's on the channel, there's going to be a link on the right hand side. You could just click it and take a trial and take a subscription by clicking through that link. Okay, that's the ad break for you. We'll go back to regular programming. We've talked about the bank rate. We just saved you from getting suckered from 10% to now it's actually 21.3%. We saw that example. Um, we also have um, the next part of this presentation. I'm going to go back to Excel because that's pretty much how it is. Karan, I don't know why it seems to be weird on this, but if you go to YouTube, there's a link posted further down. If you click on it and increase quality, it seems to be much better there. We will post a higher quality, a video when we post the recording. So here you go. We're going to just go back to Excel, and here you go. Excuse me. So let me show you something about the direct plans. Okay, there are two plans, a regular plan and a direct plan. What's the difference? One, let's say you go to your bank and you go to your bank website and you buy a mutual fund. The bank will get a commission for having basically exposed you to a website that allows you to buy that mutual fund, and then it gets paid on it forever, literally every single month and year that you stay invested in that fund. Your bank gets paid despite the fact that your RM has left his job, your bank account is probably not functional anymore, or you moved, or you've changed primary banks. It doesn't matter. The bank that sourced the fund for you gets paid this little extra amount of money every single year as long as you stay invested in the fund. The direct plan, on the other hand, does not get this, have to pay this commission. So a fund manager will have two costs, right? One is the cost of actually managing the fund. The fund manager's salaries, is bonuses, or whatever you call it. That may be, say, 1%, versus the commissions they have to pay to agents on a yearly basis. Sometimes that is 0.5%, sometimes that's 1%. Typically, it's between 0.5% to 1% for most managed funds. Some funds like ETFs have a much lower ratio because the fund manager doesn't have to do anything, he has to follow the index. But most other products, and I will come to which ones aren't in that bandwagon later, this most products will require you to, I mean, pay these commissions to these intermediary banks. Now remember, you went to your bank, you went to a website, you chose a mutual fund, you bought it. Now the bank didn't help you. Most likely the bank probably sent you a mass emailer saying, oh, you know what, flavor of the month today is a real estate construction debt facilitation fund. And you'll say, oh, okay, great, let me buy construction debt facilitation fund. You will put all your money in it, your bank will get the commission, you will lose the money, the bank will continue to get its commission, you will lose more money, the bank will continue to get commission, and in the end you will take out your money and say, I hate mutual funds. The bank will have kept its commission. The bank is not the problem. The problem is that you haven't really looked at alternatives, and the alternatives are very interesting. You want to put 20,000 rupees a month. There's a regular plan that gives 12%, the direct plan gives 13%. Why? Simple. Management fee overall, including commissions, is 1% lesser for the direct plan versus the regular plan, which means if it gets a return, it will get 1% more return than the regular plan. Remember, both the plans have exactly the same portfolio. That means if I buy 100 crores worth of stocks there, I'll buy the same exact ratio worth of stocks here. So I have the same portfolio. I will get the same return plus 1% because this is a direct plan. I put 20,000 rupees a month. In 10 years, what does this mean? I'll show you how it works. Again, it's the forward value of B1, that is B1. 12% is the rate for the regular plan. B5 is the number of years. B3 is the number of months, that is the amount per month, that is 20,000 into 12. I'm actually saying number of years is 10, so into 12. I'm assuming this, 12% a year is what you're getting, and this is what it comes down to. It comes down to 42,11,696 rupees. That is the amount you will make if you put 20,000 rupees per month in a in a fund that eventually gave you 12%. Now I'm assuming 12%. I'm not saying it's pakka, but let's assume it made 12%. Obviously, if it makes 12%, the direct will make 13%, which means the direct is going to make you, in the same formula, just using the 13% instead of the 12%, I will make 44 lakh rupees. The difference is 2 lakh rupees. This is what you paid your bank for having a website to tell you about a fund. Then if you did this for longer, you did it for 15 years, you're talking about 7 lakh rupees. Your bank just got 7 lakh rupees of your money. Now you can see how this is a significant amount of money. Over 20 years, just 20,000 rupees a month. Now here is where I'm going to give you two things in the same slice. You just invest in 20,000 rupees a month. In 20 years, if you're 40 till the age of 60, you will end up with 1.73 lakh crores. 1.73 crores just by doing 20,000 rupees a month fixed for 20 years. But if you did it with a direct plan, you will make 21 lakh rupees more. This is more than 10% of your amount here. It's 1.7 crores, add 21 lakhs, that's about what? 12 or 13% more is 1.94 crores. Now 21 lakhs, I don't know about you, but can save me a lot of money. 21 lakh rupees sounds extremely interesting, um, as an outperformance return over the long term. How do you even know how much difference there is between a direct fund and a regular fund? Let me show you. I've just tabulated this since I've gone to this site called valueresearchonline.com. Okay, and they have uh, uh, they have a bunch of products that all the mutual funds are in there. If you go to the performance tabs, they can show you the returns of 1 week, 1 month, 3 month, and 1 year. You just tabulate those, and then you do it for the regular plan. You do it for the direct plan. Then you annualize the difference. So this difference is 0.07%. I'm just going to multiply this difference by 12 because 1 month return multiplied by 12. That's the most recent commission differential between direct plans and regular plans. This is in a 3 month period, so it's multiplied by 4 instead. And this is for a 1 year period where I don't want to multiply it. I just have to subtract these two. The direct plan has given 15.39%. The regular plan has given 14.57%. I'm going to show you the same thing, assuming these returns are there available for a long time, right? So I'm just going to say this is equal to this, and this is equal to 15.39%, and I'm just going to show you what that means. The difference in 20 years is 23,85,000 rupees. That is the amount that you will make extra by just choosing the direct plan. If you've done all the hard work of selecting the plan and you're sticking with it for 20 years, HDFC Top 200 is not a bad fund at all. It's pretty much the market, but this is a fairly good fund. It's been around for about well, I think donkey's years, 10 years or so, or more. But this is an interesting way to look at what you're actually paying your bank for it. I say bank, I don't say advisor, because an advisor might actually add value. Most banks don't. Uh, just saying. This is not restricted to equity. There's something called a dynamic bond fund, a long-term bond fund, blah, blah, blah. They also have a differential of the order of 0.7 to 0.8% between the direct plan and the regular plan. So if you change these numbers according to the direct dynamic bond, you might find that your bond funds themselves have an advantage into going into direct. In fact, bond funds have more because bond funds typically don't return more than 15-20% a year. So any 1% return is like 1/20th a better return, if you're looking at it from a returns perspective on bonds. Having said that, there are these liquid funds, right? And liquid funds, they don't have so much of a differential. There you can say, okay, well, I might go through my bank. The 1 month return is, you can see the differential is very, very tiny, 0.08, 0.09%. This is very, very tiny. This is actually, if you look at it from that, it's actually this much. It's 84 basis points, 88 basis points, 72 basis points. This is 12 and 8 basis points. So 0.09% is something you might be able to forgive. I'll just give you an example of what this means. If I say this is 12%, this is 12.09%. The difference over 20 years, maybe just 1.81 lakh rupees. This is not, this may not be that significant because you're talking about 1.72 versus 1.74 over 20 years. In about a 5 or 10 year period, it's going to be even smaller. This may be an amount you say, well, you know what, my bank deserves it. So I say, okay, I'll go through with the bank. It's a difference that you have to know in order to appreciate what you're actually making someone else. In general, if you're doing all the work, don't pay anybody else, just go for the direct flap. Now what does this mean if it's, in 20 years I'm going to earn 1.72 crores? I don't even know what that means. I mean, what is 1.72 crores after? What is 1 crore? If in 20 years I have 1 crore, how much will that, how does that even, relate? Let me go back to this. 1 crore rupees then means something now. I mean, if you think about it, uh, let us say a can of a liter of petrol cost you only about 25 rupees in 1996. It costs you 75 rupees a liter in 2016. The point about it is now, if I have 300 rupees in 1996, I could have bought 12 liters of petrol, right? But the same 300 rupees in 2016 buys only 4 liters of petrol. So 12 liters versus 4 liters. So if I want to know my purchasing power, so effectively if I said today, if I can buy only 4 liters of petrol, if it was 25 rupees a liter, that means I'm going back to 1996. How much would 4 liters be? The 4 liters would actually be 100 rupees. So 300 rupees of today is actually worth 100 rupees of 1996 money. I'm going to do the same calculation here. So I'm just going to do this. How much does my 1 crore in 20 years buy me today? Just say give me the present value of 20 crores, 1 crore 20 years later. I'm going to say PV. This is the thing. I'm going to say inflation is 6% because I mean I don't have any way to know it, but I'm just going to say 6%. So number of periods is 20 years. There's no payment because payment is usually used for loans, but I'm just going to say zero at this point. And I start with 100,000 rupees into -1. So just to, because of the sign thing that Excel does, it's actually equal to 31 lakh rupees today. The same 1 crore that we talk about as a big amount of money, it's worth 31 crores. Now 31 lakhs is not a small amount of money, but it is only 1/3 of 1 crore. The same thing if I say 8% inflation, it's actually equal to 21 lakhs. So it is substantially lesser. If I say inflation is 9%, which is what happened in the last maybe 10 or 11 years, we are talking about it being worth only 17 lakh rupees. So a 1 crore 20 years later at 9% inflation will buy you exactly as much as 17.8 lakhs will buy you today. So you should think about it as it's today 17.8 lakhs, boss. So if you're going to give me 1 crore 20 years later, I'm actually going to think about it as I'm getting 17.84 lakhs. Is that worth it or not? That is at 9%. I would typically say 6% because really inflation is not as high for people who are watching this webinar. You pretty much the upper middle class or the upper class of society where your inflation is probably highest only at your children's school fee level, probably not so much at the food or at any of the other levels that we talk about. Now, let's come to the last part of this presentation. You should just focus, and this is a theory that I'm going to put to you. You should just focus on getting more money into investments. Let me start with something that says 10,000 rupees. This is the thing that I'm going to highlight now. Okay. Uh, I'm going to invest 10,000 rupees again per month. I'm going to wait for 25 years. I'm 35 years old. Let us assume I'm 35 years old today. I'm going to retire at 60. Just 25 years. Look at the formula. That means I start with 10,000 rupees. I will get 12% return over the longer term. That's all I want. I don't want higher returns. I just want 12%. Uh, so if I do this on a monthly basis, multiply 25 by 12. So I'll get 12% divided by 12 every month. I will do this for 25 years into 12 months. I will do exactly 10,000 rupees a month. And currently I have zero. I will end up with 1.87 crore rupees. This sounds like a lot, but we just did this. Let's see inflation at 6%. What are we talking about? If we got inflation at 6%, we're going to do is equal to present value of this 1.87 crores at 6% rate, and we've got 25 years, and then we're going to have a payment of zero, and I'm just going to say the future value is this much. Again into -1 so that we're even, and we see this is equal to 43 lakh rupees. I did 10,000 a month. 43 lakh is nice. It's not a bad sum. It's just a lot lesser than 1.87 crores. Can I do better? The answer is always, can I do better? 1.87 crores is not enough, and I can probably show you different reasons why. But if you're spending something like 50 or 60,000 rupees a month today, 1.87% 20 years later, 25 years later will not turn out to be quite enough to be able to manage your monthly expenses. Can I do better? Forget that. I say forget it. Do only 5,000 rupees a month. Okay. I will ask you to increase your amount every year by 10%. That means 5,000 rupees a month today till next September. Next October, you will do 5,500 rupees, and then the year after that, you'll add another 10% and so on. Why? Because, well, you're going to earn a little more every year, and you're going to have more savings, and you're just going to increment everything by 10 years. I'm going to assume the same 12% every year. The first year, you would have invested 60,000, 5,000 into 12, right? And then you'll say the corpus now, okay, assume that now your corpus is now 60,000 rupees. The interest that you've got on it is 60,000 into 12%. I'm not even doing monthly compounding, I'm doing annual compounding. I'm saying 7,200 rupees. You end up with 67,200 rupees. That is the corpus plus the interest. Next year, you invest 10% more. So, what did I do? I just took the amount that was required, and I'm going to just, oh, this Excel sometimes screws up. So, I'm going to take this B7, which is the amount I invested last year, into 1 plus B5. That is 1 plus 10%, which means I will say that this month I will invest, this year I will invest 66,000 rupees. My corpus is 66,000 plus this, plus last year's ending amount, which is the two of them. I get 12% on that, which is approximately 15,984, 16,000 rupees of interest. I end up with 1,49,000. The same thing I keep doing for 25 years. I end up with 2.07 crores, and I can show you here. There's 2.07 crores. I've invested half the amount. Today, I invested only 5,000 rupees, not 10,000. I ended up with more money than when I invested 10,000 a month consistently for 25 years. That's because it's nonsense to think of the same amount. 20 years ago, I could not have thought of investing 20,000 because my salary 20 years ago was 5,500 rupees. If you told me to invest 20,000 into anything, I would have laughed my head off. Today, I am much more capable of investing 20,000 rupees a month. Therefore, it actually makes sense to increase the amount you invest by this inflation. And you can use Excel to make a very simple calculation. I'll show you this Excel sheet. You can build your own. This is very easy. I'm going to put it up as a Google sheet and you'll be able to all access it once this is over. But this is a very, very simple Excel sheet. You can see if I invested the same 10,000 and increase it by 10% every year, I will end up with 4.14 crores. This is more than 2 times what I did with only 10,000 rupees. The little bit more every year more than doubled my extra return. I did just 10% more every year and I got the same return, 12%, but my end value was more than 2x. And in fact, I can show you how much more it is in terms of a ratio. It's actually 2.2%, 2 times more by just doing that everything. And let me show you this other example, okay? 100 rupees every single day. 100 rupees, okay? 100. I won't even say it's not a big deal. 100 rupees is what you probably spend on an auto ride back home, or you just probably spend it on, just a chai and a, going out and for a cup of coffee at a coffee day or something like that. It's pocket change for most of you. Even maybe 10 years ago, if somebody told you, can you put away 100 rupees a day, Yeah, you'd say, yeah. I mean, you know what? If I literally came to you every day and said, give me $100, and you gave it to me, you would probably not have noticed every single day for the last 20 years. Let's assume I got 10% on that money, bit on a blend of equity and debt. Let's see what its value would have been. Let's see the future value of a rate of 10%. I'm going to just say I'm going to compound it on a monthly basis. So I'm going to say give me a rate of 10% divided by 12. Number of years is number of periods is 20 years multiplied by 12 months, and I'm going to put a payment of 100 rupees daily into 30, because I know I can't compound it daily. I'm just going to take 100 rupees, save it every day, and after the end of the month I'm going to actually compound it. Okay, so I'm just going to do this and the whole thing into -1, so that that -1 thing goes away. You're talking about a number that is reasonably nice. You're talking about 22 lakh rupees. Now, 22 lakh rupees, again, using the same formula, in 20 years, may be worth about 7 or 8 lakh rupees today. But don't tell me 7 or 8 lakh rupees today is also not valuable for you, because it is. 7 or 8 lakh rupees can buy you a lot. And you know what? You never even noticed that the 100 rupees was being spent by you at uh, in the last 20 years. You just was spending an extra cup of coffee somewhere. You didn't even notice. It just went away. If I told you to do 33,000 a month, you'd say, oh, 3,000 a month. Oh, come on. No, no. But if I did 100 rupees a day and every day you just gave 100 rupees, like a piggy bank, just go and dump it in a piggy bank. End of the month, take the piggy bank to your bank and dump it in your bank account. This is what you tell your children to do nowadays. But if you did it yourself for 20 years, you would have 22 lakhs at the end of it. Same thing. Many of you can afford a lot more. Do 200 rupees. You're talking about 45 lakh. If I had done this, I would have been able to buy a Toyota Fortuner, and uh, I think I can also buy an Hyundai Elantra after that. I think that's what how much money this is. This is 20 years. If you start when you're 22, this is what you can do when you're 42. To be fair, the prices of cars have not increased substantially in the last 20 years. So perhaps that is one of the reasons why you can think of it as this thing. But you know what? If you think about 45 lakh rupees, it's probably still will buy you a lot of technology goodies, because technology goods price keeps coming down over years. So the idea is to focus on getting more into investments, not bothering about this 12%. Is it 12%? Is it 13%? Is it 9%? Come on, that's not going to make a difference to your life. It's not going to change substantially. 12% is achievable over the long term by a blend of equity and debt. We know that. Same thing at just 8%, where you take much lesser risk. You'll still end up with something like 2.5 crores, 58 crores, which is reasonable amount of money after 25 years, to a monthly 10,000 rupee investment increased by 10% every year. This you're getting an 8% return only. That's not substantially more. Uh, so let's say at 8%, I still wanted 4 crores. I would just have to find a little bit more money, probably 15,000 a month today. I don't want to take any risk, so maybe therefore I'm going to only assume 8% of a return. So yeah, about 15,500 rupees a month. I can just keep doing this or use a goal seek, and I will end up with 4 crores after 20 years. That is an 8% return. This is actually possible because 8% is available today for the 25 period. Of course, it's usually using government bonds, but I mean there are products that can give you 8% over approximately 25 years. That's the idea that we've started off with, and I hope that kind of helps you understand how to use Excel to oh, okay, Leo, to answer your question, let me just see, can you guys see the screen? um, okay. No, 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 don't divide by the 365. Yeah, I mean, you can't compound things every day. I mean, people love it, but I don't think that's possible. So let's just do it once a month. Nobody, it's not easy to get a daily compounding product. There are those. Uh, Let me see if okay. What was the question? How can I get 100 crores? Okay, here you go. Let me go back into that Excel and try to get you 100 crores. You know what? I'm going to start with something. You want 100 crores. You're not going to start with zero, right? Okay, let's assume you start with 1 crore. Yeah, here you go. I am still ending up with 10 crores at this thing. I'm going to assume a return of 12%. I want to end up with 100 crores. How much should I invest per month? Increase it by 10% every year. Is it 25,000? I'll get only to 27 crores, maybe 50,000. I'll get to 37. So actually, I'll probably need to invest a lot more. So let me keep increasing this amount till I have got there. I could use GoalSeek. The answer is actually 2 lakh. So if you invest 2 lakh rupees a month with a 12% return, increase this amount by 10% every year. In 25 years, you will have 100 crore rupees. That's a lot of money. I mean, even if you did all this thing of compounding, this, that. But of course, if you had 2 lakhs a month, you probably have a crore to start with, and so on. If you didn't have anything to start with, you'll end up only with 82 crores. You will need to invest more, maybe 2 lakh 50,000. Oh, well, that just went into a little bit of a loop. Yeah, it's 103 crores. So you like two lakh 50. So you have to have something. So the idea here is the first month you started your corpus with this amount as well. So you could do the same thing backwards and then start calculating how much you need to get to 100 crores, to 50 crores, to 20 crores, to 10 crores, however much you want backwards. So um, just doing this 10% extra a month a year gives you a lot more freedom. And to give you an example of what that means, so if you like, instead of 25, not 25, sorry, if you were to say that I wanted to invest the same 2 lakh 50,000 constantly, I will probably not get more than 46 crores, 47 crores. So I will get about 47 crores versus I'll get 100 crores for the same amount increased 10% here, more than 2x, 2.21x. That's the ratio you'll get for both. I hope that helps clarify. Suna will email you with the Capitalmind Premium discount as well. We will share the Excel sheet. I will send you guys an email. I can upload it right now to to X to well, let me just do it in a way that I don't want to hurry it up right now, but I will email you. I will upload it to a Google sheet which is shared with all of you. I hope that's okay. Is there something on the cash flow tab? Yes, there might be. That's a good catch. Yes, here you go. Okay, let me just go back in there. Uh, okay, so this is a way to calculate cash flow. Okay, so let me just say cash flow. Many of you have heard of these products. How many of you have probably heard of these products that say, "Oh, it's a month, cash back policy." Okay, so you do every year you put in 10,000 rupees. So he'll say something like this. Okay, every year you put 20,000 rupees. Okay, and then after 5 years we give you back 25,000. Then after 10 years we'll give you back 25,000, and then 15 years we'll give you another 25,000, and after 20 years you'll get all your money back and whatever is left. uh, so probably this will come with some kind of a bonus that they don't guarantee, and somehow they think that this is they'll tell you this is a good product. So let me just say this is 20,000 a year that you're putting in, and you're totally getting back 75. So you're thinking 20 years you're putting 2,40,000 rupees is equal to 2,40,000 rupees minus 75,000. So this is about 1,65. And they'll tell you, oh, we'll put some 8% bonus on top of that. So maybe you'll actually get something like another 1 lakh as a bonus, just to give you an example of what that means. So let's do a cash flow, okay, on analysis on this, because you can't calculate what the return on this is in any meaningful way. So let me start with the year 2016. I'm going to say it 1/1/2016. Oh, let's assume that the bonus they give you is 40,000, just to give you an example of how wonky this thing is. So I am actually going to pay out 25,000, 20,000, okay, for 5 years. So 1/1/2017, and I will pay out another 20,000. So I will just drag this down for 5 years. In 2020, obviously, I am going to get 25,000 back. Oh, oh, okay. So I'm just going to get 4 years are paid, and then I'm going to get this, but I'm also going to get 25,000 rupees back. I'm going to I press F4 button, the dollar signs come along. Okay, it's an Excel trick. So actually, I won't get minus; it's plus. Okay, so because I get it back. So actually, I put in 20,000, I got back 25. So I put the cash flow as 5,000 that year. So let me just do this for 20 years. Okay, so let me just do this for 20 years. That 16 will go to 2036. Correct. So I'm going to do the same thing over and over. And in 2036, here you go. 2036, oh, sorry, 20 years, correct? I got 5, 10, 15, and okay, here you go. And I will get back, I will also pay 20,000, and then I will get back this much plus this much. Is this a good deal or is this not? Let me do this formula for you. Okay, so it may be interesting, it may not be interesting, we don't know. I mean, you have no idea. You're actually thinking, hey, you know what, I put 20,000, I got back 25,000, and then I got back the 1,65,000 extra, and then I got another 40. Yeah, this must be some kind of an awesome magic voodoo policy. But answer is it may not be. Actually, let me just see. XIRR is something called the uh, internal rate of return. IRR is internal rate of return, X is extensible or something like that. um, uh, this is basically it takes a bunch of values. This is the values of the cash flow, comma, and I'm going to do the dates on the other side. So this is the date. Yeah, here you go. So this is actually nothing. This is that small of an interest rate you're getting on your investment. Okay, let's push this a little bit further. And I know that this is all very strange, so let me just move this return to here. Appreciate how tiny this interest rate is. This 40,000 bonus is bullshit. Even if they gave you a 2 lakh bonus, it would be 1.21% interest rate that you're earning. This is an annualized. XIRR is an annualized interest rate. XIRR is actually internal rate of return. It's an annualized interest rate. For them to have actually made any sense, they should have given you something like a 5 lakh or maybe a 7 lakh bonus. That's this is a decent return. So that means every year you put 20,000. After 5 years, you get 25,000 back. 10 years, 25,000. 15 years, 25,000. 20 years, 1,65,000 plus a 7 lakh bonus. That's when the return you're getting is 9.3%, which is at least some compensation for doing all this work on Excel to figure it out. Well, because if at the end of it, if it comes down to something like, he'll tell you it's 5 lakhs. Okay, that's typically how they sell it to you. This is 6.97%. You can get this in an interest in a long-term FD, which gives you a tax saving FD or or something like that. And definitely, most blended products will give you more return than this in the market, and which give you, let's say, 10% equity, 20% this thing. This is a way to calculate cash flow where such things come. I did five. Also, look at your portfolio. You might have said 6 Jan I put 1,000 rupees into stocks. 15 Jan I got 100 rupee dividend. 6th Feb I put another 1,000 rupees, then 7,000, then 1,000, then 4,000, then 1,400 I took out because I sold some stocks. I did all of this. What was my net return at the end of all of this drama? I just do an XIRR of the two, and maybe in the end, so the last day, today, 19 September, I value my portfolio and say today my portfolio is valued at 12,000 rupees. Oh, well, 9,000, no, well, 10,000 rupees, sorry. I've earned in this period annualized basis. This is always a 365-day annualized rate of 9.39%. That is the sum total of what I've done with my portfolio. Anything that has wonky cash flows, you can use this formula to XIRR to determine. XIRR as a failure in less than 365 days, you should not use it. So, for instance, if I bought something on 1/1/2016, and you got something that is maturing at 1/3/2016, and I bought it at 1,000 rupees, and it's giving me back 1,000 and maybe 28 rupees. Okay, so if I do an XIRR of these two values, you will actually see for these dates that the return is oh well, here you go. Okay, here you go. This is actually coming to 18% versus if I did the fact that I am actually going to say is equal to minus of this divided by this. That's the amount I got as a return. That's the absolute return, which is minus one. So that's the absolute return that I got. Oh, sorry about that. I'm going to just move this around to bracket. Yeah, you got 2.8% in 2 months. If I annualize this by saying into the difference of these into 365 divided by the difference of these two dates, which is 2 months. I know it, but I'm just going to do a differential of the dates. It's actually 17%. So really 17%, XIRR is 18.3%. So in actuality, the real one is what you should actually consider. The XIRR is actually not good for less than a year. So anything more than a year, XIRR is decent and can be used. I hope that helps you understand what cash flow is about. Where do you learn all of this in Excel? I have no idea. Honestly, I've been using it so long. I'm 42 years old. I think I've picked a lot of these tricks along the way. I'm not sure if it's necessarily something that has been learned by myself, or has it been, it's somehow kind of picked up because somebody else was doing it and I saw it. I said, "Oh, this is cool," and all that stuff. You can get all of this. Annualized returns for SIPs, yes, I think you go to Value Research Online, tell you this thing. So CAGR, yes, CAGR plus plus plus. What was CAGR? Um, okay, I'm going to open the floor for questions. I may have missed anything. Can you just retype the question in so I can see it now? I might have missed your earlier this thing. Coupon CM, it's actually get CM. Oh, okay. Money back policy. Money back policy. That's correct. I'm sorry. I'm just looking at CM 2016. Okay. Here you go. So, if you guys have any questions, I know it's been a long session. It's been about an hour since we started. A recording of this presentation will be made available. If you guys are looking for more, okay. If you're looking for more information, you can connect with me, Deepak Shenoy at capitalmind.in. I'm just going to go back to sharing the presentation because in case I've missed something, yes, there is one. There is a little bit of more stuff that you can talk about. We've talked about inflation. We've talked about saving a little more. Also remember that one of the things that I should cover, anything that's a bank, ICICI Direct, it has the word direct in it, but ICICI Direct is the name of the company. It's not the name of the fund you bought. It's still regular. Scriptbox, Funds India, the plan name that you actually buy, it's got to have the name direct plan in it. Otherwise, it's regular. Regular means you're paying commissions. Direct means you're not paying commissions. Nobody knows why it was named like this because they named it the way they did, but it really is something that you should consider. Um, Lastly, some rules to live by. Don't trust anybody. Typically, don't trust people in the financial field. Use this Excel to get to your returns, right? So fixed deposit rates can be trusted because that's the rate they'll give you. Their taxes and all that stuff. You understand that. You know that if you're going to get paid a certain amount of interest, you have to subtract taxes from it to find out what you're really making. But at least that is a rate that is given. And somebody tells you money back policy 25,000 after 5 years, 25,000 after 5 years, and after 10 years I'll give you 5 lakh bonus. So nobody tells you that it's an internal return of 6.97%, which is less than you can get in a bank account today. Nobody tells you that, because there is no reason to tell you that. The point is to sucker you. You just went through an Excel presentation where you figured out how. You know that they're trying to sucker you. And when you know that you're trying to sucker you, you can extract the best deal or deny products. Be happy, say no. Trust nobody. No one is your friend in this business other than yourself. Don't even trust me. If I tell you something is X, go cross verify. And perhaps I've made a mistake, or perhaps I am just saying something. It's important to make your own judgments on pretty much everything that you buy. Also, don't trust names. Okay, if HDFC Bank sells you something and you think, oh, it's got HDFC name on it, it's probably not HDFC Bank. HDFC's insurance company is not even owned by HDFC Bank. It is owned by HDFC's bank's promoter, whose name is also HDFC. So it's very confusing, but essentially, if you want a fixed deposit, make sure it has HDFC Bank's name on it. Something with HDFC insurance on it is not HDFC Bank. Now you also get a lot of products where you keep thinking about and saying, uh, this is damn good. Even that money back policy that we talked about, uh, it had 25,000 after 5 years, 25,000 after 5 years, 25,000 more after 5 years. The rest of your principal comes back after 20 years plus 5 lakh bonus. Sounds great, but you've seen that it is actually a 6.97% return. When there is lack of information, the risk is actually in the lack of information. You don't know what something means. That is the risk, and that is where you're the sucker sometimes. And when you say no, it's the other side that has to bear the brunt of whatever your anger is, for the most part. So don't trust people when they say if something is too good to be true. It probably is, because you don't have enough information. Lastly, small changes, small savings, small differentials, 100 rupees a day can change your life at the right time. If in 20 years a heart operation cost you 20 lakh rupees, then it was that 100 rupees a day you save today that allowed you to have that heart operation without even having to worry about it, because you didn't notice that the 100 rupees a day went away from your pocket today, and probably won't notice it tomorrow, and probably won't notice it for the next 20 years. Yet it saved you from having to worry about how you will pay when you got that heart attack. But let's not say heart attack, it's negative. Maybe you can buy a car, but or a TV, or you don't know what kind of TVs will be there then. Maybe with a VR set or something. Small savings will change your life. Back to questions. I hope that part is clear. You can visit us. There's a bunch of stuff that we can do. Um, we have okay. One query. When a MF scheme is switched or redeemed, SIP and lump sum investment, does the XIRR calculate the returns? Oh yeah, you can put the numbers in when you do switched. So for instance, when you do switched, okay, it'll be complicated, because when you do a switch, uh, sorry, you'll have two schemes. One is where you're switching from and where you're switching to. You got some amount in where you're switching from. Where you're switching to, you're nothing. The next month you would have switched some money. So where you're switching from has a little bit less money. Where you're switching to has a little bit more money. Add up the NAVs of both into whatever number of units you have. You will find out the value of your total portfolio on the end of that month. The switches, you just need to just say at the end of every month, what's my portfolio value, and do an XIRR, and that will calculate the returns on the overall portfolio. You can do lump sum investments also in the middle. You just have to add the right rows into every single separate date should have a row and amount associated with it, which is incoming or outgoing and so on. and in the end of the calculation should have the current portfolio value. That's it. That add all the transactions in the middle, and in the end you have a portfolio value. Switches, you have no transaction actually, because one is coming out of one and going into the other. That's fine. Redemptions you should put in there. You should also put yeah, new lump sum investments in there, or SIPs. Where do we go for direct plans? Go to this website of the company. It's a company called investstar.com. It is MF Utility. There are a bunch of these companies now. You can go to, but the best thing is just go to the website of the mutual fund. Most mutual funds, other than HDFC, have a very simple way to for you to just give your PAN card. If you're already registered with KYC, they don't need to do anything. They're just gonna put this up, give you an ability to invest, and then you're on. You don't have to do anything after that. How are real estate returns calculated? Same way, you bought something, then you paid some fees in the middle, right? Maybe you paid some interest on your loan, maybe you paid some annual fees, you paid to construct a house, you did put all that into a cash flow. In the end, you put the number you think your house will sell for today. The return is that. But you shouldn't do it every day, because there's no point. Your house value is not going to change every day. Plus, you won't even understand why you're doing this calculation. You should do it after you sell the flat, so that you understand how much you've actually made. I hope that was helpful, Yugandhar. How to park lump sum amount? There is a link that I've posted, or Vashish has posted actually as me, right on top, where there's a capitalmind.in/video. Park money, save 80% tax, also generate cash flow. That's the best way. Okay, where to? Good attempt at showing financial engineering success. Thanks, Kumar. That was very nice. I will upload the Excel sheet. If it was blurred, my apologies. I think YouTube works differently for different people, so we will make sure it's up. Um, Direct growth, dividend, etc. Okay, direct growth, dividend is just something where they pay you some money, and growth is something where they don't pay you any money. You have to actually sell your units to get money out. So in the sense, if they earn any interest, they might choose to give that interest to you as a dividend. That's one way to think of funds. But because of the tax structures, we'll do a separate webinar on those things. But because of the tax structures, the standard rule is just use growth. If you want money, take it out. Just use growth. Simple. They just complicate the taxes unnecessarily when you use dividend. They just pay way more taxes. Simply use growth in everything. If you want money, sell units. It's much easier. uh, and I'm an NRI, and I find it stressful to find tax efficient investments. Are you, if you're an NRI that's in the US, this country is going to be such a pain for you, because this is like, you got to go FATCA and this and that and all that stuff. Half the mutual funds won't even allow you to do to invest with them, and then the other half will ask you for a ton of documentation. But yes, tax efficient investments for an NRI is probably the FCNR, or I think even the NRO deposits. They don't even charge you tax, right? So you might get charged tax in your home country. I think the US will charge you, but at least India doesn't tax you so much. If you are a US citizen, or if you're most countries other than Dubai, perhaps, then you will pay tax on any Indian income that is generated. So it's better to put stuff in growth mutual fund if you can, so that you aren't actually selling or making any dividends or getting any income only when you actually want that income. And when you want that income, perhaps you're rich enough, you go stay in Dubai for 6 months, get residency, take your money out there, and perhaps then you'll never pay any tax or anything. But that's just a longer term analysis. Yeah, if you're Andy in the Middle East, most likely you don't need, you're not getting any taxation locally on an income made in India. NRO deposits, I think they don't, NRO deposits don't carry any tax, so that might be just easier for you to do than compared to mutual funds. Thanks, Yugandhar. I can help you some more with the XIRR if you just email me. Um, Okay, we have a bunch of stuff. I'm sorry, I've lost track. Um, Great. Isn't stock market better than MF? Well, I like to think so, but not everybody has the ability to, track a lot of stocks at all times. So it may be useful. You should think of investing as um, something that doesn't make you more stressed than you are. Okay, if you're getting more stress, then it's a job. It's not an investment. It should actually let you sleep peacefully. If investing in stocks tomorrow it's down 10%, you get palpitations, and it's up 5%, you're calling up all your friends, boss, I got 5%. This market is not for you. Markets are boring, investments are boring. They're supposed to be stuff you do and then go enjoy your life, right? And that's the idea, that even money that it returns is supposed to do. You're not investing in stock markets to make great returns. You're investing in stock markets or mutual fund to make yourself a better life. Remember that, because nothing should stop you from it. I was having a conversation yesterday with someone who's 78 years old, and she was saying she doesn't really want to replace the furniture in her house because she's like, who cares about it anyway? And why would I spend the money, to do this? I'm so old. I said, that's precisely why you should, because that's what money is for. Nobody is going to take away money when you go back, where when you die. So you should actually plan to spend the money, and that's more difficult than earning the money. Most people find it very difficult to spend it once they've planned for it. Yes. uh, can we hear Upticker speak? Yes, of course. Vashisht, you are in demand, man. uh, so I think you'll have to unmute yourself. Let me ask him to. Oh, just 1 second. Just 1 second. Okay, we should be on. Mic's off. Okay, cool. Okay, we'll do another time. Uh, Direct plans can be purchased directly. Yes, they can be. Yes. Leo. Uh, Another bad question. Bad. There are no bad questions. Uh, any insurance for SIP? Oh, in case of major catastrophe, I don't really know. Probably better to do things like SBI mutual fund. Even if the parent gets wiped out, the government will support it, right? Let him do that. Andy, yes, we have. We'll share the link. I think we've got Vashisht who'll share the link, the 20% off as well. What's the best software to serve MF? You know what, Goel, you have Mr. Goel, you have a bunch of things you can do. You can actually go to MF, not MF Utilities, but Amphi and sorry, CAMS and Carvi have something called FundsNet, which you can use to extract reports. There are a bunch of mutual fund software. You can even use NJ Invest, njinvest.com. I think they have the ability to allow your customers to even log in online, buy more stuff. They can't do direct, but they can definitely use some of these products as well. Mutual fund NAV does go up and down, yes. um, is my voice muted, Namdev? I'm sorry, I thought I was just talking through. Cool. Okay, we've got software and boom boom, and yes, we've got something there. Perhaps FreeFinCal. Yes, freefincal.com is absolutely fantastic calculators. I wish I could write this down, but you've got some extremely good stuff that's out there and that's free, and you should definitely use all of it. My point over here is, pay for good service, pay for people who help you do good stuff, who help you through your financial life. Don't go around paying commissions or buying shoddy products when you do not receive the kind of financial help you need. Uh, Anybody who tells you that some product is just for you, I hope this is um, a way for you to this webinar is a way for you to figure out for yourself how much it means. And perhaps we should do it collaboratively at some point, but it'll at least help you do this by yourself internally whenever you like. Yeah, value research as well does this thing, and there's a bunch of stuff here. Okay, balance funds, are they a good choice? Balance funds are very interesting. um, they invest typically around half the money in equity, half in debt. What does this mean? In the longer term, you're going to get an average return, but your volatility is going to be lesser. I would typically say if you really want something like that, what you're actually doing is something that's paying a higher fee. You typically pay about 2% in management fees for getting half your investment in equity and half your investment in debt. uh, you could segregate the two and say, I'll have one fund that is equity, I'll put half my money there, and one fund that is debt, and put another half of my money there. That just segregates your holding, but amounts to the same thing, and perhaps in some cases, a small saving in fees as well. Thanks, Vatsala. I hope you have fun reading these. There lots of interesting formulas. I haven't covered all of them, but I think this might help you understand what you need. Um, Yes, I'll do the Excel sheet. I will send an email to everybody once this is over. We're happy to do this. Uh, which one? Pay for fee only. Oh yeah, Free FinCal also has these fee only financial advice. I have no idea how good they are, but at least they're fee only, so they don't charge you a percentage of your, or they don't charge you any commissions. They ask you to invest in direct funds. A lot of advisors do that. um, we aren't in the advisory space ourselves, so we will be in. Well, let me just say, when we come there, we'll tell you that we are, but we aren't there right now, so we are not allowed to dispense personalized for financial advice. So I can't like tell you that, listen, you who should be doing this and he should be doing that, but I can of course analyze products. You have both direct and regular funds. Is there a way for you to sell the regular funds without much of a tax implication and then go into direct? Now you can now do an Excel sheet calculation of whether it would be beneficial for you to move into the direct funds by saying that whatever tax applies on your regular funds, how much time will it take for you to make that tax back if you were in the regular funds? If that time is about 6 months, a year, maybe even 2 years, because of the differential in returns between the two, then you should do it. If it's 20 years, then don't do it. Just stay with the regular. Big deal. But yeah, I'm hoping we'll be there soon ourselves. But I mean, I hope that answers your question on that. Uh, hey, thanks, Venkat. I didn't know it could. Oh, yeah, I'm sure. I'm super respectful of Mac and Apple's streaming and display. I am glad that this has come in quite well. Great. Duty, yes, dinner time, duty time for me as well. There is apparently some drama happening in Bangalore, so I don't want to get very late going back home. I hope it was good for you. It was fantastic to interact with all of you. Um, I will send it by, I'll do one thing. Why don't you guys wait? I can just probably log in and to Excel sheets and just put it right as it is as a shared Excel sheet to all of you. Um, no, I can't do that right now because if I log into my documents account, it will kind of log me out here. I'll definitely, yeah, just email Deepak Shanoy at capitalmind.in, premium at capitalmind.in. I hope this was helpful. I'll send you guys an email after this. I have all the email addresses. We'll send you the session with the Google spreadsheet that will help you, look at those formulas yourselves. Cheers. Fantastic speaking. Mail us, call us, or well, call us might be difficult because right now it's 8:30. But email us, connect with us. Twitter at Deepak Shenoy at capitalmind_in. Any one of these work. And capitalmind.in, of course. Have a great evening. Hope you do not get conned by financial products going forward, and you only get the kind of returns you desire. Cheers. Have fun. Thanks, Kumar. Cheers. Okay, how do I?